What does hedging do? Do you have strategies to hedge inflation? Inflation. We have been talking about this many times, and it is a phenomenon that we have been expecting, and if it strikes, are you prepared? Is your business secured? Today we will discuss what hedging is, and also what things we must do to hedge against inflation. We know that you are curious about the answers, so stay with us and watch this video. In finance, to hedge is to take a counterbalanced position in a security or investment that lowers the price risk of an existing stake. So, a trade performed as a hedge serves the objective of reducing the risk of unfavorable price changes in another asset. Often, hedging involves taking the opposite position in a linked security or derivative security dependent on the asset that must be protected. To help you understand hedging better, let us compare it to an insurance policy in several ways. If you buy a house in a flood-prone area, you should purchase flood insurance to hedge your investment against the danger of flooding. In this case, you cannot stop a flood from happening, but you can make plans to lessen the risks if one does. So now that we know what hedging is, we will discuss 7 ways to hedge against inflation. When inflation is high, your income doesn't go as far as it used to. But there are steps you can take now to hedge against rising prices. Number 1. Move your money into a high-yield savings account. Inflation gradually reduces the value of money kept in a checking or basic savings account, or worse, at home. By transferring the funds you can't risk investing in, such as your emergency fund or savings for a down payment on a home, to a high-yield savings account, you can cut your losses. The annual percentage yield, APY, of even the best high-yield savings accounts won't keep pace with inflation. However, compared to other bank accounts, your money will receive a larger yield. Using the most recent information available, the FDIC reports that the average savings account APY was 0.1% as of July 18. Yet, APYs on high-yield savings accounts can reach 1.5%. To find an account, look at our list of the top high-yield savings accounts. Number 2. Buy Treasury Bonds. Those who are concerned about inflation can make solid investments using common types of government bonds. Interest-bearing government savings bonds are Series I bonds. They are a low-risk investment that generates interest and is inflation-protected. They have a semi-annual variable interest rate depending on inflation and an annual interest rate based on a fixed rate. The interest rate on Series I bonds issued between May and October 2022 is 9.62%. Another type of government bonds is Treasury securities with inflation protection, Type AS. This is tied to inflation and created to aid investors in hedging against price increases. Type AS adjust in price to retain their value as inflation rates rise. Number 3. Invest in the stock market. Over time, inflation reduces the purchasing power of your money. Because of this, it makes sense to put any money you require, such as an emergency fund, in a liquid and convenient savings account. To increase your money, you should invest additional funds in the stock market. Despite occasional declines, historically, the stock market has produced returns that have outperformed inflation. The average annual return on the stock market during the previous 95 years was 12.3%. An individual retirement account, IRA, or 401, can be used for investing, IRA. An account with a taxable brokerage is another option. Use investment applications to monitor your portfolio and make investment decisions if you are still determining where to begin. Number 4. Diversify your portfolio. It's crucial not to concentrate your stock market investments on a small number of stocks. You could lose a lot of money if a firm fails or its price falls. Diversifying your portfolio reduces your exposure to risk. If one business does poorly, the other business's successes may make up for its losses, minimizing the effect on your money. Almost 40 million customers are served by the international firm Fidelity Investments, which suggests diversifying portfolios with domestic equities, foreign stocks, bonds, and short-term investments. American company shares are referred to as domestic stocks. As many U.S. stocks have traditionally generated positive returns, they are a mainstay of most portfolios. Although you can invest in individual equities, you can also buy multiple local stocks using a broad market index fund. Then you buy shares of foreign corporations using international stocks. You could earn more money because foreign corporations frequently act differently from American ones. More significant dangers, nevertheless, could also be present. Most bonds offer consistent interest income and serve as a hedge against market changes, making them generally less volatile than equities. Money market funds and certificates of deposit, CDs, are examples of short-term investments. While offering a lower rate of return than stocks, these very conservative investment options are less dangerous than other options. Number 5. Explore alternative investments. Consider alternative investments to hedge against inflation. If you currently have savings in a high-yield savings account, participate in the stock market, and have a diversified portfolio. Commodities, real estate, and precious metals are common forms of alternative investing. Commodities are the basic components needed to make consumer goods. Among them are food items, metals, crude oil, and natural gas. In order to benefit from the housing market and outpace inflation, many investors are also buying real estate investments. One option to invest in real estate is to acquire real estate, but it is considerably easier and more liquid to purchase shares of a public real estate investment trust, REIT. Investing in precious metals and gold is another choice. Investors who are concerned about the dollar's value may be drawn to the purchase of gold or other precious metals. Mostly unaffected by other asset classes, the price of gold and other precious metals is volatile. It becomes sensitive to assess your finances as inflation rates rise and determine if there are any changes that can be made to preserve your money better. You can fight rising inflation by making investments in stocks, bonds, and other conventional investment vehicles. Many sources are accessible if you want to research alternative investing. Whatever path you take, diversifying your portfolio can help you reduce the chance of losing money if one investment doesn't work out. Number 6. Purchase rental property. Real estate is one of the best hedges against inflation because, despite short-term changes, property values often rise along with inflation over the long run. One effective inflationary hedge is a rental property. The standard clause in rental and leasing agreements states that a property's monthly income should rise yearly to keep up with inflation. The annual rental increase may reach 10% in extreme circumstances, outpacing typical price level increases by 7 to 8%. You can be confident that if you purchase a rental property today, your rental income's purchasing power will last for a long time. It is reasonable to anticipate that the value of a rental property will increase faster than inflation. Yet it's important to get a rental at the proper pricing. To guarantee the best value appreciation, proper and frequent maintenance is also essential. Number 7. Leverage loans. Loans from banks or other financial institutions to businesses are known as leveraged loans. Businesses frequently utilize these loans to restructure their debt, finance mergers and acquisitions, or finance initiatives. These loans are often given to businesses with sub-investment grade credit ratings. Leveraged loans provide possible protection against inflation, as well as a buffer against the inevitably rising interest rates that go hand in hand with inflation. When interest rates increase, bond prices often decrease. As rate increases are central banks' favored strategy for controlling inflation, rising inflation virtually invariably results in higher rates in the long run. Yet, unlike most bonds, leveraged loans shift their interest rates upward in tandem with increases in significant consumer interest rates. This means that when inflation and interest rates rise, loans are less likely to lose value than the majority of fixed-income investments. Even though previous performance cannot guarantee future outcomes, historically, loans have outperformed longer-term fixed-income bonds in an environment with rising rates. Inflation is possible to happen, and many financial advisors have seen its signs. It is wise to ensure the security of your assets. So having heard these 7 ways to protect your business and your income, surely you have some ideas now about what's your next step And what is going to be your plan? It is always safer to be prepared than to cram when the problem is knocking right at your doorstep. What do you think about this topic? Do you agree with me too? Share your thoughts in the comments section below. Don't forget to like, share, and subscribe. I'll see you in the next video.